All right, hello again, my Econ students. We're back this time to talk about our very last crisis. We talked about the Panic of 1893, talked about the Great Depression, and now we're going to talk about the housing market crisis. As we talk about this, I want to warn you, it can get a little bit technical. I'm going to try to keep it as simple as I possibly can. Let me give you the overview, though. Okay, there's three things we want to focus on as we go through this. Number one, what caused the housing boom? Okay, why did housing prices double from 2000 to 2006? And we're going to talk about that. Why housing prices got out of control, so the housing boom, what caused that? Number two, why the housing bust? Okay, why did the whole system collapse and housing prices plummet, all that kind of stuff? Number three, why did that have such a drastic effect on the economy as a whole? You would understand that that particular sector of the economy, the real estate sector, would be struggling, and maybe some people on the periphery would struggle from that. Well, why did businesses that had nothing to do with housing, why did they get into such trouble with this? And that's the last part. So the three things we're going to focus on today: what caused the boom, what caused the bust, and then why did that have such a drastic reach into the economy? Okay, so again, I know it gets a little bit technical. I'm going to try to take it slow and keep it as simple as I possibly can, but try to follow me on this. Good news about the video, of course you can rewind, maybe listen to it again, maybe it'll make more sense. All right, so first though, let's talk about the housing market crisis and the three things that caused the housing bubble or the housing boom. Okay, so three things caused a huge increase in demand in housing in the early 2000s. Okay, that's what we're looking at. Why was there such a huge increase in demand for housing in the early 2000s? Three things. And I would say that if one of these three things had happened, we wouldn't have felt anything. If two of them had happened, it probably still wouldn't have been that big deal. All three happening together kind of creates this perfect storm for this housing bubble that's going to be created. Okay, so the first one here, low interest rates cause people to want to buy houses. Now, why were interest rates low? Again, I'm not going to try to make this any more complicated than I need to, but in the late 90s, there was a tech bubble that burst. Okay, now I know you guys weren't around, but in the early and mid 90s is when the internet first becomes a thing. Okay, there was a time when I grew up when there was no such thing as the internet, right? So when the internet first comes about, we really didn't know exactly what it was. We didn't know what it could be useful for. And so for every company like Amazon and Google, and a little bit later Facebook and these, for every company like that, or every online company, there were hundreds, maybe thousands that on paper seemed like a good idea, right? And there was this time where it seemed like anything on the internet was gonna be, gold, only to find out that a lot of these companies had really nothing going for them. The idea wasn't very legitimate or substantial or wasn't very well run. So bottom line is, a ton of people put money into technology in the mid to late 90s. And it kind of creates, you might want to call it a tech bubble, and eventually this tech bubble bursts. Like I say, for every Amazon that runs away and becomes wildly successful, there are hundreds of companies that tried and failed, and people lost a lot of money on that. So bottom line is, it puts our economy into a mini recession. Not a big one, but a mini recession. Now, what does the Fed do in times of recession? Monetary policy, we know this, right? What do? They put money in the economy, and that lowers interest rates. Okay, so why are interest rates low? The Fed, fighting this mini recession created by the tech bubble bursting, causes interest rates to get low. And again, everyone looks at this and says, ooh, best time to buy a home, right? So I'm going to buy that house, or I'm going to buy a bigger house or a nicer house than I thought I could afford, right? So number one, low interest rates increase the demand for consumers for housing. Okay, number two, remember all those investors in the late 90s that put their money in tech stocks and failed miserably? Well, they're all saying to themselves, I don't want to put my money in the stock market right now. That seems to be pretty cold. Where can I put my money? I know, housing. Real estate is a great place to put your money. You may not make as much money as you can in other ventures, but housing prices always go up in value, or so was thought. And so a lot of investors are looking for a place to shelter their money while the stock market is so cold, and a lot of them turn to real estate. And so they start investing in housing construction and things like that and building. And so now you have this, this huge increase in the number of homes being built and the size of homes and all that kind of stuff. So that's number two. Number three, at this time, the government puts pressure on banks to give out more loans because the government wants to see an increase in home ownership. Okay, at that time in the early 2000s, about 64% of Americans owned homes. The government wanted to increase that number to 69%. They wanted 5% more of Americans to be homeowners. Now, there are benefits to being homeowners, and the government was clearly wanting people to realize those benefits. There are also risks and sacrifices that need to be made in being a homeowner, okay? And so again, this is the government, and this is one of the problems I have. Why does the government, why 5%? Why not 6%? Why not 4%? Why not 5.5%? Why this arbitrary number? The market determined that 64% of people should own their homes. The government says, no, we think that number should be 69%. Again, it's one of those ways where I think the market does what it does best, which is figure out where things should go and who should buy what and all that kind of stuff. And here's the government kind of trying to supersede that. So the government starts putting pressure on banks to give out more loans. This is going to create the subprime mortgage. Not create the subprime mortgage, I'm sorry. They were around before then, but exasperate it, okay, make it bigger. So anyway, these three things. Okay, low interest rates. Everyone's saying, oh, I want to buy a home right now or buy a bigger home because interest rates are so low. Number two, investors investing in real estate as a place to put their money because this tech bubble burst and the stock market is cold. Number three, the government putting pressure on banks to give out more loans. The three of these things working together create this perfect storm where housing prices double over a 6-year period. Now that's pretty drastic. Usually you just kind of assume your home will increase in value maybe on average about 3% a year in value. So a home that's worth $100,000, maybe next year will be worth $102,000 or $103,000. Year after that, maybe $105,000, $106,000, and so forth. You kind of expect a slow, steady gain. Doubling in 6 years was unprecedented, okay? And a lot of it's because of these three things working together. Now, let's talk about these subprime loans. Okay, what is a subprime loan? In a nutshell, it's a risky mortgage, okay? It's someone who really shouldn't be getting a loan for a home. They can't afford it. They are going to be able to pay for it. It's just bigger than what they really should be getting, okay? Now, two things that characterize subprime loans, and part of this goes back to number three, that we just talked about the government putting that pressure on. Well, how do you give out a loan to somebody who really can't afford it, right? Well, you got to get a little bit creative, okay? It also has to do with some other things as well, but that was a big part of it. So, two things that characterize subprime mortgage. Again, mortgages given to risky individuals. Two things that characterize them. Number one, little to no money down on the loan. Now, bad idea, okay? So what I mean by this, again, I'm going to try to keep this as simple as possible. Let's say you're buying a home worth $100,000, okay? You really don't want to go to the bank and take out a loan for $100,000. Okay, because now you owe the bank $100,000, your home is worth $100,000. What happens if the value of your home goes down? Well, now you owe more money on it than it's worth. That's called being upside down on your mortgage, okay? What you want to do is put a certain percent down. Ideally, they say 20% is at least a good number. So in other words, if you're going to buy a home worth $100,000, you borrow $80,000 from the bank, and you put down $20,000 of your own cash to pay for it, and now you owe $80,000. That way, if your home does go down in value a little bit, you're probably still safe, okay? And you're not going to owe more than it's worth. Well, during this time, again, they were trying to give out loans as quickly as possible, and so a lot of people were taking out loans and putting little or even no money down. In some cases, they're actually given money on top of what the home was worth. So that was sometimes called the 103% mortgage. You were given $103,000. You were borrowing $103,000 for a home worth $100,000 to help you pay with closing costs and this and that. Again, bad idea, very risky. The other problem is what we run into with adjustable rate mortgages. Now, for my money, guys, at some point in your lives, most of you all be homeowners, you always want to go for the fixed rate mortgage. Fixed rate mortgages are certain. There's no surprises, no gray area, okay? Fixed rate mortgage basically means you take out a loan and you're going to pay back the exact same amount every month for the life of the loan, whether it's 15, 20, 25, or 30 years. If it's a 30-year loan, you will pay the same payment every single month for the next 30 years, okay, or unless you sell your home or whatever else. Here's how adjustable rate mortgages work, is they, just like they sound, they float up and down. And usually how they go is this. When you first get this loan, you're going to get a really low, very affordable interest rate, say 2% or 2.5%, right, on a mortgage or something like that. And that's true for a couple years. And then they'll tell you, it's not like they lied to people, they'll tell you, hey, 3 years later, this interest rate is going to become adjustable. And it could go up or down or whatever else. And so your 2%, let's say you start out and your payment on your house is $800 a month because you get such a low interest rate to start out with. And you're like, I can afford $800 a month, no problem, right? Then let's say that the interest rate balloons to 6% or 7%. Now all of a sudden your $800 payment becomes a $1,700 a month payment. Now where $800 you can handle just fine, $1,700, that could be a problem. You might have a hard time affording that. Now, here's what was going on though. Remember, and this is kind of like we talked about with the stock market in the 20s. Everyone wanted to get in on the action in the early 2000s. People were buying homes, flipping homes, making tons of money. The housing market was exploding, right? Again, you don't want to get left behind. So a lot of people, knowing that this day is coming, they say to themselves, you know what, well, I really can't afford a home, given my situation, a traditional, 20% down, fixed rate, all kinds of stuff. But I can afford this no money down and this adjustable rate mortgage. I can get a home to start with. Okay, now 3 years from now, I know that my interest rate is going to explode and my housing payment is going to explode as well. Well, easy. I'll just sell my home, make a ton of money, because everyone is making money, and the assumption was that housing prices always go up in value, right? So 3 years from now, easy. I'll just sell my home, make a bunch of money, put that money into a new home, and now I'm living the dream, right? And so that's what a subprime mortgage is. These risky mortgages given, typically characterized by little or no money down and adjustable rate mortgages. Well, guess what happens 3 years later when all these people who took out these bad loans or loans they can't afford, they all try to sell their home at the same time. Guess what happens to the price of homes when 6 people on your block are all trying to sell at the same time? Well, how do you sell your house first? You lower your price. And then your neighbor lowers their price. And then somebody else lowers the price. And you just keep, and it's this nasty spiral effect where housing prices end up plummeting. Not to mention, there were a lot of people who took out these loans they couldn't afford, and as predicted, they weren't able to afford them, and the bank forecloses on them. And so, essentially, long story short, you have everyone trying to sell their house at the same time, okay? And when that happens, housing prices tumble, and that puts a lot of people in this impossible situation where I mentioned the term upside down a moment ago. Again, upside down means that you owe more on your loan than your home is worth. Now, here's the problem you run into. Okay, so you bought a home for $200,000. So you owe $200,000 on this home. Okay, now your house is only worth $120,000. Okay, and your payment just went way up and you can't afford it. Now here's the problem. You can't afford to make your monthly payment, so now you got to sell your home. But now how are you going to sell a home that's only worth $120,000, but you owe $200,000 on it? That means that you have to pay $80,000 just to sell your home. Now, if you had $80,000 laying around, making a monthly payment probably wouldn't be a problem, right? So you have all these people who can't afford to pay their monthly payment, and they can't afford to sell their home because they owe more than their home is worth. And so what happens? They get foreclosed on. That means the bank basically says, you're kicked out, we own your home. Now, as foreclosures rise, ask any banker. They're not in the housing business, okay? That's not what they do. If they have a house or if they have an asset that they've seized, they pretty much want to get rid of it as quickly as possible. How do banks get rid of homes as quickly as possible? Put the price really low. So again, now on your block, you've got 6 homes for sale. 3 of them are foreclosures that are selling really cheap. Good luck selling your house when all these other homes are trying to be sold at the same time, and this is what happens. It's this nasty spiral, and the whole system kind of collapses, okay? So it was this ugly process of this huge demand for homes, increasing the value, people taking out loans, and loans being given that people can't afford, and then all of a sudden everyone's like, I gotta get out of this as quickly as possible. Everyone's trying to sell, housing prices plummet, and that's the bust. That's the bubble bursting, okay? Now, as you would expect, that's going to have huge ramifications for the housing industry or for the real estate industry. And here's the question: why did that have such an effect on the economy as a whole? Now, I know I've been probably a little bit technical from this point on, or from up to this point. It's going to get a little bit worse. Try to follow me with this complicated idea of securitization, okay? So securitization is when banks pool loans together and try to sell them as an investment, okay? Now, that probably made no sense to you. Let me give you an example, okay? And this is a made-up example, but this is what was happening a lot during this time period. So again, you're a bank and you've got all these loans that you've given, and you know they're junk. You know a lot of people aren't going to pay them back. You know they're risky. You know it's just bad news, right? So some banker gets this brilliant idea: hey, let's put these loans together and let's sell them to other people as an investment, okay? People that want to, mostly businesses and corporations and city governments that have pension plans for their employees and things like that, we can sell them to these people. So again, let me give you an example. Let's say that LCA has a pension plan, okay? We don't. We've got a individual retirement account, a 403B we call it. But anyway, let's just say we have a pension plan. How pension plans work, pretty simple. Every time an employee gets a paycheck, a little bit of your paycheck is taken out and put into this big pot, okay, that is going to go to the retirees. When people are ready to retire, they get to draw from the pot. And that's how they live for the rest of their life, right? By getting money from this pension plan, right? So employees are putting, it's kind of like Social Security, but it's done privately by a company. So people are putting in, employees are putting in part of their paycheck every month. You retire, you get to take out of the pot. Well, of course, corporations and companies and again, local governments, they don't want that money just sitting there. They would like for that money to grow, to earn interest so that they can treat their employees to an even better retirement, right? A happy employee is a busy employee, right? So let's say that, again, LCA has got one of these pension plans and there's $10 million in it. And Mr. Sisk is thinking to himself, you know what, I want to invest this $10 million on behalf of my employees. So how can I do this in such a way that is, again, safe, but makes them money, okay? So Mr. Sisk goes to his financial planner or the school's, whoever works with the school on this stuff and says, I want to invest this $10 million we have in our pension plan. And the guy says to him, well, Mr. Sisk, normally I would say maybe some wise investments in the stock market, say mutual funds, things like that, is usually a good idea. But as you know, the tech bubble has just burst and the stock market's not doing very well. It's not a very good place to put your money right now. You can always put your money in government bonds and things like that. It's not going to get you a great return, but it is safe. But I tell you what, Mr. Sisk, there's this new thing. So you know how banks give out loans to people to buy homes and cars and things like that. They give out these loans and people pay back their loans every month with interest, and banks earn money off the interest, and that's how they make money. Well, you know what banks are doing now? They're actually taking these home loans and they're selling them to guys like you and to companies like yours. And so what's going to happen is you are going to own these mortgages. And as people pay back their mortgages every month with interest, that interest goes into your pot gets bigger, and your employees get a nice, healthy retirement. And Mr. Sisk says, wow, that sounds great. But what happens if people can't pay back their loans? And the guy says, oh, no problem. If someone can't pay back their loan, then the house gets sold and the value of the house goes into the pot. And you know how homes always go up in value? There's almost no risk here. And Mr. Sisk thinks, oh, this sounds great, right? I'd love to do this for my employees. So he says, here's my $10 million. Buy a bunch of these, what's called mortgage-backed securities, these loans that were pooled into investments and sold to companies like LCA and other school boards and like I say, local governments and other corporations, insurance companies. When you pay money every month for your car insurance, again, they don't want that money just sitting there. They like to invest it in something safe, but something that can grow. And so insurance companies were buying into these. So a lot of companies that have nothing to do with real estate end up buying these mortgage-backed securities. Well, when the housing market crashes and home prices plummet, all of a sudden, remember that $10 million that we had in our pot that Mr. Sisk was investing for us? Well, now it's only worth $3 million. And all our employees who are getting ready to retire, Mr. Sisk has to send them a letter saying, I know we promised you a certain amount of money for retirement. Well, we don't have it. We put our money in these mortgage-backed securities, and now we can't afford to pay for your retirement, at least not to the extent we did before. So you either need to work until you die, or this is a big problem. This is what a lot of companies were getting into. So a lot of businesses that were buying these, again, have nothing to do with real estate. They end up suffering big time because of these mortgage-backed securities that they ended up buying. And so that was why it had such far-reaching effects into the economy as a whole. And then the last stage, of course, banks end up getting into trouble like they did in the Great Depression. People can't pay back the banks the money that they owe. Banks end up suffering. Banks stop loaning. Banks kind of freak out and they freeze up for a little bit. And again, what do we know about the money multiplier? Money is created when banks give out loans, and when people pay back the loans, well, now loans aren't being given, loans aren't being paid back, money disappears, deflation sets in, recession. And that's in a nutshell. So again, I know that's a complicated story. That's as simple as I can possibly put it. But the three things you really need to get from that: why there was a housing boom, okay, why did demand increase and prices increase so much in the early 2000s, why the bust from about 2006 to 2008, to put that in context, is when this bust is taking place, okay, and then why did the economy as a whole get into such trouble? Because of these mortgage-backed securities. Okay, so those are the three things that hopefully you glean from that. And again, I know that's complex. If you have any questions, though, by all means, shoot me an email or text message, and I'd be happy to explain further or go over it or say it differently. But there you go. Hope that helps. Hope you found that interesting. And otherwise, hopefully, guys, as always, I hope I see you sooner than later.